Welcome back everyone. Today we've got a bit of a portfolio update. It's going to be quite an easy one for me, to be honest with you, where I'm just going to sit here with a camera and a laptop and talk to you about what's changed in my portfolio this week. Got plenty to get through today. We've got Asos, which has gone on a bit of a tear today. This is Thursday I'm talking about this, so it could have changed by Saturday or Sunday, but Asos is already going up 11, maybe even 12% today. And that's in the face of some really bad news for them. So we'll discuss why that might have happened. And also some big news for one of my dividend companies, Lennar Corp, who are saying that they've raised their share price by 50%. This is based on great cash flow, and this is one of my favorite companies in my portfolio right now. And I'll dive into why they might be raising this dividend so much and what the risks are going forward for Lennar right now. And finally, you might notice looking through here, I've added a new stock to my portfolio, a very small position, but we'll discuss that position at the end and why I'm investing in it. Current portfolio value is 41,598. We've had a rocky road in the past couple of weeks, haven't we? The S&P 500 for me has dropped down 5%, bringing me almost in line with my actual income pie, which is absolutely crazy. But overall, we've had Discovery make this massive move this week, and that's been very positive for what's a very new position for me. I don't expect these positions to just blast off straight away, but that's one of the things that Discovery's done. And I'm almost completely greenwalled, except for the Vanguard FTSE emerging markets, which has largely recovered. I'm waiting for a good recovery today. But with the US markets opening up, there's a very good chance that this is going to go green today. So overall, looking through my portfolio, the only one that's let me down is AT&T. But first, let's talk about Asos. Asos had its earnings results out this week. In fact, I think they've come out today. I haven't had a chance to listen to the earnings report, but I think I know what it's going to say. Asos has had a very tough time recently, losing about 50% of its value. The same with Boohoo, and it's all because of the Christmas hit because of the supply chains. Even though Asos is a very good online retailer that benefited heavily from 2020, it did get significantly overvalued. And we've seen that big reversion back to the mean now, and I'll show you how Asos works as a stock. It's a very interesting one. It's a very good case study to talk about mean reversion and how stocks get very excitable sometimes. Because the news has come out that their growth has been stunted by the Christmas hit. But if you're invested in Asos, then you would have already known this because they released guidance on this a long time ago, possibly like 3 months ago. And that's what led to the big 45% crash. And today they've released their results and they are actually very positive. They've actually grown 5% in their revenue this year, and they've also got a very good gross margin. These numbers are not that bad, and they're a lot better than what the market was valuing them at. I think personally the stock has been boosted most of all because of this news that's come out that Asos plans to move to the main market of the London Stock Exchange. If you didn't know, Asos is covered under the AIM market, which is the alternative investments market on the London Stock Exchange. It's now moving to the main market, which is the big boy market. There's a lot more liquidity in there. There's a lot more traders willing to go for that. It's a kind of a good sign that your company is now a stable company. It's very sought after to be on this part of the exchange, and you kind of have to get let in more than you can go, oh yeah, we're going on this now. But I think that the main market has been asking for Asos to come over for quite a long time, and it's kind of refused. It stayed in AIM for a little bit. There will be money reasons why they did stay on AIM and didn't go to the main market, but now they've decided to make that move. It makes them a much more credible investment company. It makes them very much more likely as well to get on the FTSE 100. And obviously when your company gets on one of those big indexes, you start to benefit from all that index money, all that Vanguard, all that BlackRock, those sorts of big things. Because it's a 2.5 billion market cap for a company that regularly revenues well above that. Last year was 3.9 billion. Obviously this year it's a little bit lower, well, a lot lower, and that is what's causing the dip. But we should already know this. The market should have already understood that this is what's going to happen. And I can show you, it already does. Look, here is the analyst estimates for 2022-23. And it's already been accounted for that Asos will have a big dip in 2022 from its backlog from the supply chain issues. What we have to try and do now as investors is figure out how much this is going to overcorrect, how much this share price is going to go below this line. If it follows 15 times its PEG ratio exactly, we could see a little bit of a dip, a lot more of a dip, maybe 40 odd percent more of a dip for Asos right now. But because Asos is a long-standing growing company, it's very unlikely that it's going to massively overcorrect to the downside. It's likely that it will flow around this area for maybe 2 or 3 years now. So if you're looking for some short-term money off Asos right now, I wouldn't bet on that. It's very possible that it will happen, but I just wouldn't bet on that. I'd look at Asos as a company going forward over the next 5 years and seeing what they can actually generate based on past results. And if we accept that this 2 years is a bit of a blip, Asos isn't going to stay in this slump, and once the clouds clear, it's going to go back to normal as a growing company, as a fashion icon here in the UK, online sales, and it's largely the disruptor right now rather than the disrupted. If we believe all those things are going to stay and we think that Asos is going to stick around for another 5 years at least and it's going to continue growing, then we're right to think that we might just keep this at a PE ratio of around 19 or 20. You know, it could go much higher. Growth stocks have been going higher to the low 30s right now. But if we keep it at a mid-range of 19, then we can see an 8.87 return year on year. And the good thing about Asos right now is that if it doesn't get that multiple expansion, if it sticks with its growth and even contracts another 5 times earnings, we still get a 3.91% growth year on year. So this is quite a reasonable investment for me here. I can see where the growth would go, and I can see how much you could possibly gain off it. There isn't a ton of downside in my opinion. Obviously, if it doesn't drag itself out of its supply chain issues and the whole partnerships with deliveries doesn't work out as it's supposed to, then Asos could have a bit of a problem, but that is a risk in the market that you have to take. What's wonderful about Asos is that it does grow year on year, but the share price is very, very tradable. When I say tradable, I don't mean that I'm going to sit and try and trade it anytime soon, but if you were a trader, then you could really understand how Asos works. We get lots of hype and lots of excitement about Asos, a growing clothing company, an online brand, and generally very good supply lines. But when the company doesn't grow as much as people expect, it doesn't have a massive exponential growth, but it has a nice, steady onward, upward growth, people lose faith in it and the price just mashes back down. And it's done this 3 times now over the course of its lifetime on the stock market. It's diminishing in those returns, and I would expect something very, very similar to happen going forward. If not, I would expect that the share price would now grow very, very steadily over the next few years. So rather than seeing these big spikes, you might see maybe another spike, but a little bit lower as the market really decides over the long term what Asos's price is. Remember, in the short term, the stock market is a voting machine, but in the long term, it follows earnings. And Asos's earnings are very good, and they're likely to be very good going forward. Next up, I'll talk about Lennar Corp, and the markets have just opened, so we've seen a rise of 3.66 already today. That's based on the new news that they're going to raise their dividend by 50%. It's a good sign that they've got such good cash flows at the moment, and Lennar is dedicated to giving back to shareholders right now. Lennar is one of my favorite companies. It's one of my companies like Broadcom or KLA, one of those companies that I really dived into quite deeply and developed a good understanding of what their market might look like going in the future. And that so far has all paid off very, very nicely. I've sold and I've gained on Lennar quite a few times now. So right now it says unrealized is 12.86%, but I think I'm much more in the green than that. And there's a number of reasons why Lennar is doing so well. First of all, during 2020, America was short more than 5 million homes. That means that all the big home builders needed to build homes quicker. Supply chains were an issue. Again, there's going to be a massive story of 2022. It's not going to stop. But it means that there is a lot of appetite for building homes, particularly new builds in America. There's been a lot of hate towards old builds as well because they're all wooden and they're quite they're falling apart and things like that. So new builds in America are much more favorable than they are here in the UK, where a lot of people don't like new builds. They prefer the old style housing, mainly because it's built with bricks and it'll last forever. As you can see here in America, they're built with wood, and that's a very different story. You can see here the difference from 2008, when we had such a massive supply of houses in the market. That's because everyone could just buy them all day, every day. And then once regulations came in, the number of houses that were being built, because of how scared everyone was of the market, went down quite considerably. And it's been relatively flat from there until 2020, when it just went through the floor. That has now recovered going into 2021. But that is not because more people have bought all of the houses. It's because more houses have been built. There's no lapse in demand. It isn't like more people have been buying the houses like they have been here because of low interest rates. It's because there's more houses being built. That's what's raised prices, and obviously a company like Lennar, a home builder, is going to benefit from raised prices. Forecast going forward, this is cash, and this is what we want to see. I have had this on my radar for a very long time, all because of that inventory, all because of the housing inventory being low. It should have been very obvious to quite a few people that houses will need to be built. 2020, 2021 has just sort of accelerated that process. This is a cyclical industry though, and if you look past at 2008, things can go very wrong. So when a housing bubble pops for Lennar, that is going to be a really bad time. But if you notice, in 2008, they lost all of their cash. They had to really fight to stay alive. And their share price also dropped 88%. So for Lennar, I'm very, very happy to keep it going while the going's good, but I'm going to have to be very careful. And obviously with the volatile market out there, and I would love for the housing market to collapse so I can afford to pay for my own house. I think I do need to still be wary, and there's going to be a time when, if I can get the cash flow to maybe 20 times multiple, that might be the time where I decide to sell out of Lennar. But for now, 20 times multiple seems a long way away for Lennar. I think I'm going to let this one ride for another 2 years, and I think it will safely outperform the market. And finally, Vestas. If you follow my Instagram, Briscoe_investing, you'll know that I bought Vestas wind systems. I've only bought a little bit, and Alitor, there is a video coming out to explain further details on Vestas. That's this one. Vestas, I have only started a small position in them, £210 so far, because they have been on a downward trend for quite a long time as they fell with the rest of the renewable energy market and the EV stock. But I personally feel that Vestas stands out from the rest of them. Vestas' new product is called the Inventus platform, which is a modular type wind turbine. Sorry, I should have explained that Vestas is a wind turbine company. It makes all the new renewable energy wind turbines. It's got a huge market share. In fact, I think it's the biggest one in the country. I'll get onto that in a second. But it makes these modular type wind turbines, which are very easy to ship in and out, and also very easy to maintain and repair, which is another big arm of Vestas' business model. This is quite funny though. This is when I came across this on the site. I just have to play you. It's like it's the Walking Dead or something. I think I'm gonna have to. It's a very viral kind of end to that video. Kind of a weird message, a weird feeling I get off that that video. I might cut that out in a minute and put the Walking Dead music onto it. But Vestas is the largest wind turbine maker in 2020, making up 14.8% of the global wind turbine market. Behind them is Goldwind, which is a company which I haven't looked into, if I'm honest. It might be a private company, I'm not sure. And of course, GE and Siemens are the other big one. Another favorite of mine, Nordex, is in there, and Ørsted might be around there somewhere as well. But Vestas is the largest wind turbine maker. I think it has 39% of the US market, and there is a lot in the UK as well. I'm actually trying to find a couple of Vestas wind farms in the UK so I can go visit them and really have a good look at what they look like. Revenue each year goes up, and this is the most important part of Vestas' business model. It's actually profitable. Believe it or not a lot of wind turbine makers are profitable. In fact, none of them are. And the Vestas CEO is very, very angry about this and believes that in the future, a lot of them are going to merge or vanish to stay alive. And Vestas doesn't need to do that. It's actually quite a, it's not a high cash flow business, but it could choose to be a high cash flow business if it wanted to be. In fact, it pays a small dividend based on that cash flow. But because, again, this should be a supply chain episode, because again, Vestas had problems during supply chain. A lot of the other companies like GE and like Siemens, their wind side of the business isn't actually profitable either. Vestas seems to be one of the only profitable wind turbine makers at all. Their new CEO, he believes a lot of the other companies aren't going to be able to survive like Vestas can. And looking at their financials, it does look like Vestas is well ahead in the lead here. A lot of this is down to their repair and their upgrade system. So the Inventus, I believe, could be upgraded every single time, whereas the new big GE Halidane something, that is just one big unit that goes plonk on there and they have to pull it all down once they want to repair or upgrade it. Vestas can all be done in place, and that's a big selling point. And guess what? Vestas do it all as well. So they make a lot of revenue on their repair and replace. Oh, and I've also got this little article here that shows that even Equinor, one of the largest oil majors, I think it's an oil major, but it's Norway's big oil major, they've gone to renewable energy largely. In fact, the largest offshore wind farm in the world is totally unprofitable. But today, Vestas' share price has gone up 2%, quite a big bump for Vestas. It doesn't normally fluctuate that much, to be honest with you. Obviously, a nice big downward trend, still quite overvalued. I'll go to valuation in a second, but it's gone up 2% based on this news that the US has announced a massive lease sale on offshore wind. It's 6 sites off the coast of New Jersey and New York, and it's very likely that Vestas is going to get a good share of this. Most likely, one of the energy companies buys this, and then Vestas gets bought in as the cheapest and most cost-efficient supplier of wind turbines for all these farms. They obviously won't get all of the farms, but it's very good news that the US is investing quite heavily in offshore wind right now. Okay, a quick look at Vestas on the fast graph right now, and you can see that it is currently quite overvalued from a price to earnings perspective. But if we go to the custom forecasting calculator and we select estimates based on analyst estimates, we can see where the supply chains are starting to affect Vestas, and that's going to be very hard over the next 2 years. It's going to be very tough for Vestas and other wind companies to actually become profitable, and that's what the CEO was talking about. It's very possible in the next 2 years that you're going to see a couple of these companies get bought out or even just go completely bankrupt. But in order to make you some money over the next 5 years, Vestas needs to maintain a 22 PE ratio. Now, this is much more of a risky play on my part. This doesn't seem like a great margin of safety. That's why I've only put in £210 so far. I'm letting Vestas just do its thing right now. I'm going to see where the market thinks that Vestas is going. If it goes down, then I'll probably start to double in, and as it goes down to a more of a reasonable valuation, I'll start putting in. But if it goes up, then I've already started my position, and maybe if it becomes one of those massive Amazon type unicorn companies in the future, then I will happily take some money on that £210. So this is a very low risk. I'm not allocating a lot of my portfolio to it, but this is a very exciting company. I like Vestas. I like where it is in the world. It's got a huge market share. It's actually profitable, and they've got a good team behind them.